All right, as of the close of the year on Monday, we've got more evidence that the stock market has completed at least an intermediate cycle low. There's an off chance that this may also end up being a final 4-year cycle low, although I'll make the case later that I think it's probably going to come in the spring of next year with one more lower low. But as it stands right now, I think we've got an intermediate cycle low. Typically, the first 12 to 20 days of a new daily cycle and a new intermediate cycle tend to be the most powerful. And so far, that's playing out here in this first week. We of course had that big 4%, 6% in the Nasdaq move off the bottom. Huge buying thrust. 95% of the volume was up volume. That was the first clue that we probably had a bottom. And then on Monday, the S&P gave us the second confirmation by closing above the 10-day moving average. When the moving average is falling this steeply, that's a pretty good sign of momentum if it can close above it basically on its first attempt. Sometimes it takes 2 or 3 attempts to get above a moving average when it's falling this steeply, so that's a positive as well. All right, now since we did actually make a slightly lower low last week, then next week would actually be week 1 of a new intermediate cycle. My expectation at this point is that the market is probably easily going to get back up to this level, 2600, and I really think it's going to probably get back up to this 2800 zone up here, this kind of a triple top, and I'll show you why. About probably 95% of the time or greater, an intermediate rally will have to break the intermediate downtrend line before it's complete. It works in inverse in the other direction. Before an intermediate decline is complete, it usually has to break the intermediate uptrend line. So you need to take out the technical buyers and the technical sellers. You do that by breaking a major trend line. And not until that happens can can the advance or the decline be complete. So we need to break this intermediate downtrend line here, and that's probably going to mean we're going to have to go above 2700. This is 2700 level here. So in my opinion, the most likely spot would be we're probably going to get up here to the 2800 level, probably right before the FOMC meeting. That'll give the Fed cover to maintain their hardline stance on raising interest rates. That's probably going to disillusion stock market traders again, and then I think we probably got another move back down to test this low sometime in, I would guess, March or maybe April. But I do think this rally is going to get above, well, the odds are very high it's going to get above this trend line, and probably it's going to test this triple top level before we run out of steam. Next chart, you can see the semiconductor index has already regained this consolidation zone. This has been the leading sector since the 2016 election. I had pointed out in previous videos, and actually let me widen this chart. All right, so here was the top in 2000. This is at about 1360, give or take. When we were in this phase here, I kept telling people we weren't going to top until we got to this point, but I also said that it's very unlikely we could get a sustained breakout above this without either a long period of sideways consolidation or pullback. We're getting the pullback, but we are going to break out of this. This is This top has been in place for going on 19 years now. So this isn't going to last forever. We're going to get a breakout above this level. And I think this pullback is just about over. Like I said, we may get a move back down again in the spring, but once that is done, I think you're going to do yourself a disservice listening to the perma bears that they're still trapped in this mentality back here in 2009. They're still waiting for the next shoe to drop, and that's just not going to happen. We've started another secular bull market, and this is just a very severe pullback, no different than 1987. Let me widen this chart out, and I'll show you what I mean. So you can see once we completed the second, the double dip recession in 82, the market really took off to the upside, and the 200-week moving average basically acted as support all the way up until we got our top and then started our secular bear market. Even the 1987 crash still just came back down to test this long-term support. The recession in 1990, same thing. And then once we entered the secular bear market, price went through that average. The average turns down. We get a double top in 2007, and even the second worst bear market in history. This so scarred investors' psyches and mentality that even 10 years later they still can't let go of it, and they're still looking for the next shoe to drop. And so many traders are expecting a repeat of this, and it's just not going to happen. You can see we are following this same secular bull market pattern. Get a bottom here, we're getting a bottom here. Same thing we did on the way up here. The long-term average is sloping up. I'll say this again, secular bull markets are driven by technological advance. This bull market here was driven by the invention and integration into human society of the personal computer and the internet. Changed the world as we know it. And we had that long period of sideways secular bear market consolidation as we have to digest these huge gains. And now we started another secular bull market, and it's being driven by the same factors that drove this one. We're getting huge gains in the biotech sector, nanotechnology, robotics, autonomous transportation, clean energy, and just a huge swath of new technology that is going to improve life on Earth for humanity. That is what is driving this bull market. Yes, it's being helped along by very lax monetary policy, and that's probably part of the reason why we just gotten a little stretched above the long-term moving average, and we had this very severe correction. Same exact thing happened right here in 87 as the personal computer was just starting to proliferate and become more popular with the mass society. Things just got a little ahead of itself. Price got too far above the long-term moving averages. We have a big crash. Resets sentiment, resets the overbought levels, and then off we go again. Same thing's happening here. We're not going to do another one of these. This secular bear market is over. All right, moving on to the McClellan oscillator. We've got a very powerful move off the bottom. That's indicative of a final intermediate cycle low. The stronger this push is, the more powerful the move off that intermediate bottom. If this initial push were to, let's say, make it to 100, then I might change my expectations and say that this was a final 4-year cycle low. rather than looking for another retest of those lows in the spring. So we'll just have to see how the next couple of weeks play out, and whether or not this push off the bottom maintains the extreme momentum, and just how far this the McClellan oscillator goes on this initial push. You can see out of the February ICL we had a pretty strong push, and the initial move came up to about 50. If I widen the chart out and we look at the 4-year cycle low in early 2016, you can see the initial push out of that that bottom, and this was a divergent low. So the bottom in the stock market actually occurred right here, not here. This was the first leg down. Second leg down occurred with a divergence, which is often the case. And then you can see very strong breadth momentum push off of that bottom, indicative of a very strong rally to come over the next 2 years. So I'm watching this to see how strong this push is off of this low. If we were to get up here to 80 or 100, I might have to change my expectation and say that maybe we are finished with the 4-year cycle low, and we are not going to retest those lows in the spring. And I'll end with a look at sentiment. You can see at the recent low a couple days ago, sentiment was more extreme. Retail traders were more bearish than they have been at any point in the last 10 years, even more bearish than as we were moving into the final bottom here of the Great Recession and the second worst bear market in history. So I see a lot of traders still extremely bearish, and I mean, you can just look at history. It's just never really a good idea to be bearish when these type of emotional traders are this lopsided on one side of the market. And even if this were a bear market rally, which I don't think it is, we're going to need to recover sentiment, at least back to the neutral, back to 50% bulls before I would expect this rally to roll over and start another leg down. But like I said, I think this is more similar to what happened in 1987, where we just get a very strong regression to the mean correction, resets everything, and then we start the next leg of the bull market.